Welcome to the November 2022 monthly motor checkup. My name is Dave Lundgren, and I am the founder and chief market strategist here at Motor Capital Management and Research. The topic for this month's video is Crisis Bear Market Averted for Now. In this month's video, we're going to take a look at a few things. First, we'll start with the big picture and assess where exactly we stand in the context of this bear market. Take a look at the tactical setup. What's the best action to take now, given where we are within that bigger picture setup? And then ideas for this environment, which sectors to favor, which industries and stocks. And then we'll finish up with a look at portfolio recommendations. How much exposure should we have on gross and net, and what percentage of our overall risk budget should be engaged, given the environment that we're in. Just let's take a quick look at the risk gauges before we really get going into the video here. We know that at the end of last month, this is where the risk gauges finished, and they were all in risk off or sitting right on top of risk off at that longer term time frame. If this tide, which again is basically the quarterly chart, the fundamentally driven chart, if that drops into risk off, then I think we have a crisis bear market on our hands, which would open the door for another basically another 20% decline if we go by history as a guide. So what we really need to see is to see this oversold condition manifest into a powerful enough rally to pull these two time frames out of risk off. So when we fast forward to today, I'm recording this on November 8th. We have seen this short-term time frame work its way into or I should say out of risk off into mixed. So that's a good start, and that also resulted in this wave period. The monthly chart went from 9 to 8. So that's at the margin. That's a good sign, because this time frame here cannot avert a crisis bear market, i.e. go down to 8. It can't avoid that without these time frames first coming out of crisis themselves. So we've got an oversold condition that's trying to work its way off through higher prices, and we'll talk about that as we go. But at this point, what we're really focused on is what kind of repair work that we see in this time frame can translate into repair work in this time frame as well, thereby allowing us to avert a crisis bear market in that longer term, fundamentally driven quarterly time frame. These three charts basically take a look at the more popular averages. We have the S&P 500 over here on the left, then we have the NASDAQ 100, and we have the IWM, with a small cap ETF. And as we're working through this oversold condition, which we established in October, I'm really less inclined to view any kind of a rally as being positive unless we can take out these resistance zones that I have marked here across the averages. And I would just say that the closer we get to 4,000, particularly if we get there without any repair work being done on those the ripple and the wave time frames, the weekly and monthly charts, if we get into these zones more deeply and we haven't seen any repair work, then the signal there would be to reestablish short positions, maybe take down some long exposure that perhaps didn't perform well during that rally. And just once again, we're in a bear market, and we need to be tactical. We want to keep our exposure low and be very flexible with our net exposure as we oscillate through these overbought and oversold conditions. And we want to keep that strategy going until we can indicate that we've ended the bear market and we're evolving into a new bull market. But before I leave these charts, what I wanted to point out was what I thought was interesting was how the S&P 500 hit a new low here in October, as did, of course, the NASDAQ 100 hit a new low, but note how the small caps did not. So again, the way bear markets end typically is you have a series of divergences. I put those in the leading indications of trend change because they don't indicate trend change. They just suggest that trend change may be forthcoming. And so the fact that we have this divergence, and I have another one that I'll show you later on in the video, is a good sign. Divergences are divergences until they're not. Unfortunately, and so this could easily be wiped out by a new low in the IWM. But as bottoming processes go, this is a typical indication of a bottom, but we're definitely not willing to put any capital at risk just because of this divergence. This is more something to just monitor. And then I would also point out that we've got the resistance zones identified, and note how far into the resistance zone that the small caps have gone. In fact, they've gone all the way back to the 200-day average. So we'll see how this manifests, but I think it's something to certainly monitor and see how these resistance areas hold up as we move forward through the course of this bear market. These two charts are really important to monitor going forward. This first one here is a index of the best momentum stocks, and this is this chart here is an index of the worst momentum stocks. And so just looking at these two, we can see that they're both in downtrend. So even the best momentum stocks, the ones that have the highest ranks in momentum, are in a downtrend. And when you have that as a condition, you know you're in a bear market. If the best momentum stocks are in a downtrend, you're in a bear market. So we can say that for sure. And until we see repair work being done on these two charts, there's just really no reason to elevate your risk allocation and to take on higher beta names and gross up your exposure. Just noting that during bull markets, even the worst momentum stocks are in an uptrend, right? But in a bear market, when you have them both in a downtrend, no reason to be taking on elevated risk. I will say, as I mentioned earlier, there was another divergence I wanted to point out. It is a good sign that the best momentum stocks did not hit a new low in October, whereas the worst momentum stocks did. So again, divergences are a leading indication of trend change, so it's not necessarily reason to put incremental risk. Certainly, you can put incremental risk on, but don't go overboard. You want to adhere to the dominant condition, which is the fact that both of these are in a downtrend. And so any additional risk you take on as a result of this divergence should be very tactical in mind, and you should also be willing to exit those positions on a failure in the context of this ongoing downtrend. This is a bit of a busy chart, but what we're looking at here is this black line is the S&P 500. You can see where it peaked here, and what I want to point out is these other lines are the rolling 6-month correlation between the momentum factor itself and the other remaining factors. And so by looking at the direction in which this correlation is heading gives you a good indication of what the momentum factor owns. So when the market peaked out, we can see that this factor here, the correlation with this factor, turned down. And this, of course, is the large cap versus small cap. So this indicated that the factor was favoring large cap stocks. We see this turn higher in the orange line, which is quality. So it began to favor quality. The turn higher in the gray line is low beta, beginning to favor lower volatility stocks. And then the turn higher in the yellow line was was value. So as this market began to turn, the momentum factor had already been rotating into these other factors, basically preparing for the impending bear market, which momentum has a tendency to do. It does a pretty good job of sniffing out major market turns and allocating and rotating into the factors that tend to do better in those environments. And so that's what we see here. And as we're looking for evidence of a market turn, we're going to want to see these things reverse. We're going to want to see the momentum factor slowly starting to rotate towards higher beta and lower quality and things like that. So as it obviously stands right now, that is not the case. So from this perspective, we see no evidence of a bottom in this bear market. So I want to keep these risk gauges at the sector level in front of you each month, just to keep tabs on the health of the leadership sectors as well as the laggards. And of course, this is the markets risk gauge, which we featured at the very beginning of the video, just for a frame of reference. And as we move through the sectors, here's energy, the #1 ranked sector, and you can see that it's all risk on across the board. And so, perhaps that means we're due for a pullback here, but nonetheless, the context for the pullback is quite strong, right? That long-term, fundamentally driven risk gauge is in risk on. In fact, it's the best it can be. So it's a healthy backdrop for weakness, which is what we kind of featured last month. But again, when you move over to the second sector, staples, #1, the fact that it is staples is not particularly encouraging because that's a defensive, bearish leadership type of a sector. But keeping in mind, this is the #2 sector, and the best we can point to is neutral. In these two longer term time frames are sitting right on top of the risk off, which would put you into crisis mode. So this is the #2 sector. And then as you move to the right, industrials, this is new for this month, which I'll show you in a moment, making its way up to #3. But again, #3, you can see that it's in crisis mode. So that's the third best Fourth best is utilities, taking on a lot of pressure in the very near term. Not quite enough in the long term to get it out of this number 4 spot, but this is clear indication that this sector is under pressure, and given that it's in crisis mode here, not sure how long it's going to hang on to this number 4 rating. Number 5, financials. Again, very mixed. Materials, very mixed. A couple of them in crisis mode. So this is the leadership. And once again, leadership in a bear market, with the exception of this one sector, is just simply in and of themselves, all else being equal, they're rather bearish. So nothing to get too excited about here from a leadership perspective, which really tells us that there's just nothing to get excited about for the market overall. And of course, taking a look at the lagging sectors, number 7, healthcare, number 8, consumer discretionary, obviously very much under pressure. Real estate, almost at the worst it can be across the board. So yeah, sure, maybe that means we can get some sort of a bounce, but the long-term context for any kind of bounce in real estate is bearish. Technology, this is a sector we want to see leading in a bull market, and it's not only not leading, it's number 10, just one from the bottom, and in crisis mode. So nothing encouraging there. And then communications and media, it's across the board. In fact, it's the opposite of energy. So again, this is the laggard part of the market, and as long as the laggard part of the market is in clear bear market, we can certainly entertain shorting this area, and that's something that obviously we've been recommending. But we're going to want to see this area of the market get better. It doesn't have to be leadership, but with this much pressure in the laggard part of the market, once again, there's just no reason to be optimistic about the broader market. Now, putting this all together, we can see how the various sectors shake out in their rank. And once again, highlighting that industrials have worked their way up to number 3, which I think is an interesting development, given that we are in the throes of a bear market. A cyclically sensitive sector working its way into the top is a potential positive. I don't want to make too much out of it, but it's certainly worth noting. And I think from an exposure standpoint, there can be some exposure there in industrials. But once again, we don't want to get too excited about it, because at the end of the day, we still are in a bear market. And then just technology is clinging to the bottom rung of this leadership rank, and you can see that this is the rank overall, and these are the various time frames from short term to long term, and you can see that in the 3-4 time frames, there's no effort whatsoever to improve the technical structure here, resulting in a 10 here. Of course, communications and media is just stuck at 11 across the board. So there's just a lot of work that needs to be done down here in these sectors that typically lead bull markets. And so as long as these are as bad as they are, we just really want to curb our enthusiasm and keep our risk budgets low. Consumer staples and the utilities still in the leadership. Here you can see utilities again weakening, but nonetheless, nothing here to excite us and give us any encouragement as to the near-term outlook for the market. And it's well understood that bear markets tend to transition from bear market to bull market, one stock at a time, one sector at a time, and they do that by just trends reversing in stocks within the sectors, breaking out to new 52-week highs. And so this table here tracks exactly that. And we're just looking at what percentage of the sector has hit a new 52-week high X months ago, and that X is running across here. 1 month ago, 2 months ago, 3 months ago, etc. And so when you look at energy, we can see that a third of the energy sector has hit a new 52-week high in the past 1 month. And then as you trace over here, we can see that this is 6 months ago, the last peak we had and you can see that 35% of the energy sector hit a 52-week high back then. And the good news is with respect to energy is that only 7% of the sector has its 52-week high more than 12 months ago. So this is a very broad, very healthy trend that we see in energy. But then when you just move down to the next sectors, I mean, there's very few 52-week highs being hit here, and at the market level, it's only 10%. And what we find when we move to the right, by the way, these sectors are presented here best to worst according to their rank. when you move to the right here, you can see that, for instance, 58% of the healthcare sector hit its 52-week high more than 12 months ago. And then you can just trace down here and you can see how bad it is. So there's just a lot of work to be done. The market will not and cannot bottom until we start to see individual stocks within the market bottom. And from that perspective, when we look at a chart or a table like this, there's no evidence of that happening. We can also track the percentage of each sector that is hitting a 52-week low. And when we do that, of course, energy being the leadership sector, we can see that only 3% of the sector has hit a 52-week low in the last month. And 75% of the energy sector's 52-week lows were hit over a year ago. So once again, very strong technical structure in this sector. But unfortunately, as you move down to the next remaining sectors, you can see a third of the market overall has hit a 52-week low in the past month. And then just a whole swath of new 52-week lows are being hit in this month, even within the leadership, right? So industrials, utilities, 53%, consumer staples, 19%. So this is just not healthy behavior. We really want to see most of the 52-week lows being hit 7, 8, 9 months ago. We're not seeing that. We're seeing growing 52-week lows taking place in the past month. So nothing here to indicate that we have a bottoming process in the making. So therefore, no reason to take on any increased exposure or risk within the budget. As strong as the energy sector has been, I think it's worth noting that the sector has only just recently taken out its more than decade-long relative performance downtrend on this most recent move higher in relative performance. So again, it's oftentimes it's difficult to really lean into leadership that's been strong, particularly over the past year or two. But just stepping back and gaining the context of these longer term trends, we can see that energy arguably is only just starting to get going. So yes, it is up against resistance. The whole market itself is in a bear market. So it's likely that we'll get some sort of a pullback in here. But as that's taking place, the most important thing to focus on is the fact that during an ongoing bear market, energy continues to lead and has only just now recently taken out a more than decade-long relative performance downtrend. So I mentioned earlier that the industrial sector is working its way up into the leadership. We can see here that the sector is ranked number 3. So I thought we'd take a closer look at the sector in this video. So just to reiterate where we are from the risk gauge perspective for the industrial sector, we can see that all 3 of these time frames are just hovering just above risk off. And if, of course, this one falls into risk off, we have a crisis mode in the industrial sector. So we need to really see some strength here. But having said all of that, the sector is ranked number 3. And I think one of the reasons is that it's ranked number 3 is that during the entire bear market, which, the industrial sector is highly correlated with the broader market. I think it's one of the highest correlated sectors to the market. So it's not surprising to see that the industrial sector did peak with the broader market. But despite that, the relative performance has actually been strong all year long. So much so that it's recently just broken through a multi-year relative performance downtrend. So this is really, truly intriguing to me. Again, we're in a bear market, industrial sector, which is cyclical in nature and highly correlated with the market. Rather than fully participating on the downside, at least from a relative perspective, it's broken a multi-year relative performance downtrend. So this could be an indication that when the dust settles and when this bear market is over, this is a sector we're going to want to have oversized exposure to. This over here is a listing of all of the industries within the industrial sector, and the table is ranked according to the industry's rank. And one of the things I like to do is as you drag your finger down the list of industries, the question is how far down the list do you go before you get to a rank that's below 50? And when you do that within industrials, you get pretty far down the list, almost 3/4 of the way down before you get to a rank below 50. And the further down the list you go, the stronger the technical strength is, and the broader the leadership is within the sector. So the fact that nearly 3/4 of this sector is leading is a positive indication for the potential for this sector to be leadership once the bear market is over. Okay, before I move on to the next slide, I wanted to just quickly provide some context regarding what drives the performance of an individual stock over time. So this is a study done by Morgan Stanley. This data in a whole conversation around the philosophy of trend following and tying it all to fundamentals is available on the website. If you visit www.motrcmr.com and go to the philosophy tab, you'll find this chart plus a whole bunch more. And what this study did was it looked at the drivers of performance for individual stocks over 1 year, 3 year, 5 year, and 10-year time horizons. And what we find is that in the short term, nearly half of what happens to a stock is driven by valuation expansion and contraction. So it's very sentiment driven. But then as you move out 3 years, 5 years, and 10 years, you can see that fundamentals come to dominate the story, and in particular, top line revenue growth. So it's for this very reason that when I'm looking for individual stocks to consider for either this research product or for the funds that I manage, I'm really focused on top line growth. And this data, in addition to other studies that have been done, including William O'Neill's work, this is the reason why I focus on top line growth. And all of this is to sort of put into context the conclusions from the next slide. So given my focus on top line revenue growth, what I've done here is I've bucketed the 2,200 or so stocks that I follow according to their top line revenue growth. And what we have here is we've got a bucket called 50.1, which means that the stocks in this bucket have revenue growth that's at least 50% and the company's profitable. 50.0 indicates comparable top-line revenue growth, but the company is not profitable. And what you can do is look across the line here in each of these revenue buckets and treat them as if they were a single portfolio. And if you were to buy all of these 249 stocks, 39% of them would be in the energy sector. So once again, it's probably shocking to most that there is so much top-line revenue growth coming from the energy sector when most would think that it would be healthcare or technology or other sectors. That's not to say that there's not rapid revenue growth in these sectors, but it's unprofitable. So look at healthcare, mostly biotechs, 34% of this particular bucket. 24% of this bucket is technology. And as you move down, you can see 35% revenue growth between 35 and 50, but unprofitable is, once again, very heavily weighted towards biotechs and technology. And as you follow all the way down, you look at how much technology represents in each of these unprofitable buckets. That's a pretty good revelation in terms of what's happening in the tech space. Lots of revenue growth, yes, but a very large swath of these various unprofitable buckets are dominated by technology. So when I'm looking for ideas, I'm looking for strong technical structure, but top-line revenue growth to boot. And right now, unfortunately, the only place we find that is the energy sector. So we are, of course, painfully aware that growth has been underperforming value for quite some time. And so the question is, how long can this go on? How long can growth underperform value? And so this chart gives us a little bit of insight into that question. The top panel is small cap growth versus value, and the bottom panel is large cap growth versus value. And when we look at this relationship, we can see that small cap growth versus value has led the market lower, and it's been leading this relationship lower as well. So this is sort of our tell. And what we can see here is that this relationship has gone all the way down to its the trend line support off of the global financial crisis lows. So it's completed a pretty deep bear market in and of its own right. But as a guidepost as to what might happen to the large cap relationship, were this to go all the way down to its own trend line off of the global financial crisis lows, this relationship has an awful lot more to go on the downside before it's done. And I believe that until the evidence points otherwise, I think that's what we need to expect. Now, that might sound like almost incredulous. It might sound impossible that it could be that bad, but we need to remember that this is not our first rodeo. This has happened many times before. It happened after the 2000 peak into the global financial crisis lows. It happened after the Nifty 50 in the late 1960s, and of course, it happened after the euphoric growth bull market in 1929. So this is not new. It sounds painful, but it's something that I think from an expectations perspective, I think until the evidence suggests otherwise, we all need to be open to the possibility that these large cap growth names have quite a bit of underperformance left ahead of them. Next, I want to address the bearishness reflected in sentiment polls. Typically, when sentiment polls show extreme bearishness, it's a contrarian buy signal. But in my mind, that's only true if that longer term, fundamentally driven trend is still bullish. And as I indicated earlier, that is not the case today. In fact, the trend structure hasn't been this bad since just before the GFC meltdown. You can see here how bearish investors were then, and yet the GFC meltdown happened after everyone was so bearish. Now, this is not to say that the GFC-like meltdown is forthcoming from here, but until we can start to check boxes in the other direction, I am mindful of the bearishness, but I'm also mindful that the bears may actually be right this time. So just to wrap up this month's video, I just wanted to give a quick update on my outlook for Bitcoin and cryptocurrencies in general. You know, this 18,000 level has been a major support for Bitcoin. It includes the trend line all the way back to its foundation, as well as the highs from late 2017. And I produced this chart earlier today, and my understanding is that it's kind of gone below the support level. So the idea is that, you know, if we view crypto as being a risk-on, risk-off asset, this is yet another risk-on asset that is breaking through major supports. If I look at this chart pattern here, this is a double top. It targets down to around 12,500. That looks to me like where we're headed, and between here and there, it looks like it's just more pressure to be put on risk assets, which of course we would need to put equities in that bucket. So this is just one more warning that the overall environment is still not conducive to taking risk, and to the extent that you have a risk budget, I'd keep it on the low end. Okay, so tying this all back to the portfolio, given what we've discussed with respect to the broader bearish environment that we're in, how should we have our portfolio positioned? I think at minimum we should be thinking about low gross and low net exposure. This is not a risk-taking environment. The net long at least until 4,000, but beyond that, once we get to 4,000, that's when we want to think about reestablishing any short exposure. I would be overweight energy, industrials, and financials, and then shorts should be concentrated in technology, consumer, and media. How do I get there? So if you look at this relative performance signal model that we refer to from time to time in our notes, on the bullish side, it runs from 1 to 10, all being leadership stocks, but some of them are established leadership, and then others are developing leadership. And then on the laggard side, running from -1 to 4 is established laggards, and then from -5 to -10 is emerging laggards. So regardless of the environment that we're in, we want to always be pushing the portfolio towards leadership on the long side. And when we look at established leadership, those buckets are dominated by energy. So once again, we want to have exposure there. I mentioned earlier the industrial sector, and how it's just starting to come on in terms of leadership. We can see that it's now ranked number 3. You can see how here it dominates these emerging leadership buckets. So again, once again, energy should be a featured exposure in your long portfolio. And then over on the short side, of course, keeping in mind the tactical nature of the environment, when you were oversold and compressed as we were in October, you want to reduce your short exposure. And then as we go across the range, get into those resistance zones that we talked about in the S&P between 3,900 and 4,000. If we get across the range into those zones and there's no repair work in those, the gauges, the risk gauges in the weekly and monthly timeframes don't come up out of risk off, then we want to re-engage with short exposure, and we want to concentrate those exposures in these established laggards, which of course is technology in consumer discretionary. So that's where we stand today. Unfortunately, not a lot has changed from last month. It's very much a tactical environment. It's frustrating to be sure. Bull markets are a whole lot more fun. I can only say that we will have the ingredients for a bull market once again at some point in time. But in the process, I suspect, as it has in the past, we'll pick up on those changes in the future when they do happen. What I just can't say is, where we'll be when that happens. Where the S&P will be. Will it be down at 3,000 when things get better, or will it start to get better as soon as I finish the sentence? I have no idea, and I don't actually care. I just want to be on the right side of it. And as I look at the data today, the right side of this environment right now is sideways to down. So I would just once again just keep your exposures low, keep your risk budget intact, and don't spend it here today because it's just not worth it. This is not a risk-taking environment. We'll continue to update you on what we're seeing in terms of changes in the risk gauges and various shifts within leadership across the sectors throughout the course of the month in our weekly MOTR reports, and of course in our next month's video. Between now and then, if you have any questions, feel free to reach out at any point in time, and of course we're happy to discuss markets and exposures at any time with you. Thanks again for listening, and we'll be in touch soon.